we should be thinking about a range of different homeownership programs. So, for example, some people will be able to benefit from standard mortgage products or from FHA insured mortgage products that have somewhat lower interest rates. But other households could potentially benefit from larger and sort of deeper levels of assistance. So, for example, there's a set of programs called shared equity homeownership. And these programs basically take a subsidy and use them to help bring homeownership down to families at lower income levels. But the subsidy stays with a home typically, rather than being given outright to the individual. And what this does is it brings homeownership within reach of a low and moderate income household. But then when that household moves on, that household builds wealth through a shared mechanism. They don't get all of the home appreciation. They get a share of the home price appreciation. And then the rest of the home price appreciation stays in the home and is available to help the next home buyer in the form of a lower home price. So essentially, it's a way of taking one initial investment in home ownership and using it to help one family after another afford the high cost of home ownership. So, if you take all of those different pieces together, I think you have a pretty powerful suite of programs to help low and moderate income families. People should not be in what we called exploding ARMs, which were adjustable rate mortgages, where the rates would go up radically after an initial period of stability. That's not good for the household because they're not going to be able to pay those higher interest rates, and it's not good for the community in which they live. So we basically, those kinds of things are largely off the table. We also need to make sure that the debt-to-income ratio, is reasonable, and that we do a full underwriting that looks at people's credit scores, and we're not looking, for example, at people's stated income rather than their actual income. But there's really good data that suggests that when loans are underwritten fully, when people are given safe 30-year fixed-rate mortgage products, that even low and moderate income families with very, very low down payments, between 0 and 5%, can sustain home ownership effectively. This was during the home ownership crisis. So the Family Self-Sufficiency Program has been called the best kept secret of the asset building world. It is a program that is open to families in subsidized housing, particularly public housing and the housing voucher program. And it has three main components. One is to stable, affordable housing, right? So everybody who's in FSS is living in public housing or has a housing voucher. So their housing status is stable. They're not worried about where they're going to sleep tomorrow, and that enables them to focus on really getting ahead. Second piece is working with a financial coach or a case manager that helps families overcome barriers to increased earnings. And some programs also work with people on their credit, for example, and on helping them navigate the homeownership process. And the third is an incentive for families to increase their earnings. Basically, as their earnings go up, they pay more in rent, but that extra rent goes into an escrow account. So really, it takes these three pieces, it puts them together: stable, affordable housing, the coaching / case management, and this asset building financial incentive for increased earnings. And together, it really creates what I think is a pretty effective package for helping families to build assets, and improve financial capability, and increase their earnings. There are currently 69,000 participants nationwide, but it's a program that could grow. There's authorization to increase that number. Right now, it's administered by housing authorities, and it's really not as well known, perhaps, as it should be among individuals, organizations that are focused on asset building. So one thing that I'm really interested in seeing is more partnerships between housing authorities and asset building organizations that have skills in financial coaching and credit repair and that kind of thing, to really work together to strengthen financial capability through this program. I think the best way to approach this is to really dial back. Don't look at the data necessarily from the last 5 years, because it's just been a very unusual time. And don't look at the data for the 5 years before that, where the home prices were running up, because those were equally unrepresentative. Let's dial back. There was a a wealth supplement to the PSID that was developed in 1994, and it looked at assets among renters and owners. And what it showed basically is that if you were a low-income renter, you basically had no assets. The only assets that low-income households had from this data source were homeowners. And if you were a middle-income minority household, the same thing was true. You only had assets basically if you were a homeowner. So I understand there are some complicated causality issues. Do high levels of assets lead to homeownership, or does homeownership lead to assets? But basically, the data, I think, are very consistent with the point that homeownership is probably the single biggest and most important asset building vehicle, provided it's sustainable. What I really want to focus on is the opportunity to incorporate financial capability more holistically into our subsidized rental housing programs. So right now, the Department of Housing and Urban Development provides rental assistance to about 4.5 million households nationwide. Financial capability is not a core deliverable as part of that assistance right now, but it could be if we were to think differently about that opportunity. So what if we were to, for example, develop a asset building component to subsidize rental housing, so that every household that came in and entered subsidized housing would have the opportunity to build savings, either through increased rent that they paid due to increased earnings, or perhaps through some set aside. There are some efforts underway to try to pilot this and develop this and model this, and certainly we can build on the existing programs like the Family Self-Sufficiency Program, which is a HUD program that helps families in subsidized housing to build assets. But the reason why it's important is number one, this is a population that tends to have very low incomes, so it's the right target population from an income perspective. Second, they're stable from a residential standpoint, so they're not worried about where they're going to sleep tomorrow, so they might be more ready for a more intensive intervention. They also tend to be in subsidized housing for a number of years, so there's an opportunity to work with them over an extended period of time. And finally, because they have a housing subsidy, they will have more money available to pay their debts and to otherwise work on improving their credits, their credit perhaps than some other households would. And so it's a really, I think, promising population to work with.